Every cycle has a point in which prices defy both logic and gravity. There are times in which people are faced with a choice: buy this house, this asset, this investment at an elevated price, or risk coming back at a later point and buying at a potentially higher price. Thanks to manipulated ultra-low interest rates, bubbles have formed just about everywhere, creating a complete misallocation of capital on a scale never before seen. But it's simply a part of a cycle. It can continue for a very long period of time and defy the odds, just as we have seen. But like every other bubble, the bigger they are, the harder they fall. Just make sure to protect yourself. You came here for the truth, so let me unveil that for you. Today we are going to talk about bubbles. You know, Hubba Bubba and Bubblicious and all of the others. No. Of course, we're talking about assets. We're talking about investments. We are looking at different things that have popped up that some people probably didn't even know existed. That's right. Okay, so we're going to look at that information today. I'm going to show you what you need to know all around that. Give you some charts, give you some articles, and try to put it together in what I try to condense it to 10 minutes, but every time I end up going overboard because I'm trying to give you the historical context, the investor context. Anyway, let's go. I wanted to lead off with this article here, and I think it is really important to remember where the weakest points are today, because everybody looks at the stock market first and says, look, my Apple stock and Amazon shares, I got 7 of each, and that is going to take me into the billionaire status. But we need to understand where the linchpin is, and it's always going to be where you have that weakness. Where there is that weakness, you're going to see that fragility appear, and you know specifically that when you look at office space, when you look at retail, and the malls especially have taken a really, really hard hit already, and we are only in the beginning stages of that. I think there's going to be some big changes coming this year, 2021, and we'll see how it unfolds. Mall values plunge 60% after reappraisals triggered by bad debt. Landlords looking to walk away from some struggling centers. And this is a very serious issue today, and I know a lot of people don't want to talk about it, but we have to realize that this is something that is kind of ringing some bells back to 2007, but this time it's with commercial real estate. U.S. mall values plunged an average 60% after appraisals in 2020, a sign for more pain to come for retail properties, even as the economy emerges from the lockdowns. About $4 billion in value was erased from 118 retail anchored properties with commercial mortgage-backed securities debt after reappraisals triggered by payment delinquencies, defaults, or foreclosures. That's the big deal right there. And this is where we should keep our focus. The retail, the office, that's the key right now. If you look at real estate as it relates to, the average person, this is what the average person looks at their home value and they see, hey, look, it's gone up. The real estate market's doing well, but they don't even understand how it all connects. It's all put in these garbage pools, and they have these, these derivative packages, and you look at, what they do, and they stick it here. Here's a mortgage, here's another mortgage, here's another mortgage, and another one. You and your neighbors don't all have the same credit. You and your neighbors may not all be in line with each other. One of them starts to fail. One of them doesn't pay their bills. Well, now suddenly that package that they're all in, it doesn't look as healthy because some of the people haven't been paying their bills. The same thing goes on the real estate, in the commercial side. It happens in everywhere. These derivatives exist all over the place. You were told that derivatives were safe and they were fantastic back in 2007, even into 2008, and we know right now that they are not. So understand the way that works. It has nothing to do with you and the fact that you've been paying your bills. That's a different story, and I absolutely hate it when I have to read that information over and over again, telling me that it's okay, seeing the comments say, there's nothing to worry about here. No, this is ridiculous. My goodness. I don't want to talk like a clown, but I feel like sometimes it's the only way. All right, the average drop, which reflects the change in value since the debt has originated years ago, may underestimate losses when the properties come up for sale because so much retail real estate is in distress and few buyers are willing to take the risks on aging shopping centers as e-commerce continues to grab the market share. It's an eye-popping decline. When we're forecasting a loss on these malls, we're even further haircutting that value. So of course, they know that the future here, especially for these B and C malls, is not very bright, especially when there's such an abundance of them. If they can re-strategize and look at things maybe a little differently and start to change things around, I mean, sure, there could be some benefits there, but I don't think for the majority of them it's going to turn out well, and these derivatives will start to fail. Bubble risk, a reckoning in markets as the economy recovers. I mean, Shaq has a SPAC. What could go wrong? One economist says the euphoria ripping through Wall Street and raising a new round of worries. So this article just talks about all the different things that are going on today as it relates to the bubbles. I'll cover just a few points of that. If you want sort of an overview, you can read this article. Bond investors are now suggesting that they believe the confluence of easy money policies from the Fed and other central banks, massive stimulus from Washington, and a potential boom in consumer demand coupled with lower supply could lead to an inflation spike later this year. This goes in line with what we have seen many other individuals, Bill Ackman and others, that have been suggesting that things are going to get hot and heavy. You look just further into it and you realize that it's not just people, imagining these things off the top of their head. There's real underlying problems here that they don't ultimately have control over. And fears about bubbles are percolating throughout the financial world. Results of a recent survey by investment management firm Tightest of institutional investors found that 41% expect a correction in the real estate prices and 39% foresee corrections in tech stock and crypto values. I don't know what's going to happen. I can't predict the future, but I know that this is what they're talking about simply because when things go up in a straight line, it's usually going to correct at some point. That doesn't mean it comes down all the way. That doesn't mean you have a 100% drop or a 90% drop. No, there has to be corrections along the way. We have yet to see that. Even if you look at it realistically, back in March 2020, it really wasn't even a correction. Yes, technically it was a correction according to the technical analysis around it. But, if you actually look at what happened, it wasn't a correction whatsoever. So those numbers right there are just a fraction of what we could really see just for some of that to clean up, your detoxification process like would be in the human body. That right now we haven't seen any of that whatsoever. So that is frightening, at least as far as I'm concerned. This is an interesting one out of Reuters. And of course, we have seen what's going on with copper and with lumber and with others, but this one is talking about steel. US manufacturers grapple with steel shortages and soaring prices. Not a good combo, of course. Everything that then gets made with this is going to be higher in price. And as a result, you're going to have putting pressure on the consumer side or whoever's the end user. So looking at that ultimately just shows you that higher prices mean you have people with less disposable income, you have lower profits, whatever it might be, it's usually not good. Now, the people who are supplying these products might be able to profit more, so it's beneficial for them, but there has to be a balance. And the faster that things come up, there's less time to sort of, figure that out and get it worked out. And of course, it's generally not a good thing in the short term. An aerospace parts maker in California is struggling to procure cold rolled steel, while an auto and appliance parts manufacturer in Indiana is unable to secure additional supplies of hot rolled steels from mills. They just go on to talk about the disruptions that they've been experiencing over the last year. They're looking at the tariffs that were in place, and all of these things have created a market for the steel manufacturers that have been quite disruptive, to say the least. And that's really what it's discussing. I don't want to go into it further, don't want to bore you with the details, but just understand that many of the commodities here, there are different reasons why this has sort of been all over the place and generally more expensive. But anyway, here's the info if you need it. My favorite topic to talk about here for real estate is, of course, Toronto real estate, where Toronto has one and only religion, and that is real estate. That's right, people and buying their homes. It is an actual sacrifice. It's a ritual. It's a religious belief beyond any other. In fact, there is no other because Toronto real estate never ever defies you. It only ever goes up. That's right. All right, enough sarcasm for today. Toronto home prices on pace to top $1 million after record year. That is ridiculous. Now that's Canadian dollar, of course, but in relation, US dollar and Canadian dollar has become a little closer. The point I'm trying to make here is that people are technically able to afford this because of interest rates being so low, because of mortgage rates being so low. But it doesn't explain how this will work as interest rates rise. Oh, don't worry. They stress test everybody. If mortgage rates do rise, people will have to be able to afford it, right? Right, absolutely. But study after study after study after survey after survey after survey show that people are paycheck to paycheck, and they will not, I repeat, they will not be able to afford it. But here we are with homes at $929,000, the average home price in the GTA, the Greater Toronto Area. $929,000. This is going to end very, very badly, and I will stick to that. The bigger this gets, the worse it will be. Part of what is happening here is that there is supposedly very, very low inventory, right? Actually, that's not an accurate statement, as Real Investment Advice had mentioned, and I definitely do agree with it. Any home is on the market. When you think about it, if somebody knocked on your door and offered a price that you're willing to sell on, I'm sure there's people that don't want to move under certain conditions, but I do believe that everybody has a price. And you will see people that often get that. An investor comes knocking on doors. Hey, I know you don't have a sign up anywhere. It doesn't say for sale, but I'd offer you this price. Would you take it? And there are so many cases where that happens. So the inventory that they mentioned there, it's such a tight inventory, is not necessarily an accurate measure. I don't really like that. But regardless, that's what they're talking about here. And you see the sales to new listings ratio that's been taken off. There has been, this euphoria going on, and it's going to continue at least for the next little while. We'll see what happens as we move in, which is generally a hot period from spring into the summertime. We'll see if it picks up. Market expectations for a Fed rate hike trajectory from December 22 to December 24. I don't know if they're ever going to get to this territory. We'll have to see. Of course, if there is inflation, they only have one option. 4 rate hikes is a lot, considering the fact that they have supposedly not even thinking about increasing interest rates, but that's where we're at today. You can see the 10-year yield, which was continuously going higher and higher throughout February. It had come down a little bit. We'll see what happens over the coming days. By the time you're seeing this, who knows where it's at, but this is something that has been frightening people in the investment community. They were told, no way, no how, interest rates are going to stay low forever, but that might not be something that they have full control over. Goldman's U.S. Financial Conditions Index continuously was getting easier, basically through 2020 into 2021. Now it's somewhat tighter. So we'll see. Historically still, of course, very, very low, but I want to see the trend. I want to see where that heads. Look at the home purchase mortgage applications that had declined through 2021. And why? Because interest rates, of course, the mortgage rates, I should say specifically, started to go a little bit higher. So you have less people refinancing. That's changing. As they move further and further down, that incentivizes people to refinance their mortgage in the United States. And you could see that it had picked up, and it's still, of course, just around that 3% mark. But I think it's important to note what people are doing and how they respond immediately to changes in the mortgage rate. Something to follow for sure. This is just an article out of Bloomberg, just commenting further on what I was talking about. Mortgage rates hit a 6-month high, threatening U.S. housing boom. Real estate rally has been fueled by cheaper borrowing rates, tight inventory pushing the prices higher. You could see what's been going on. I think it's pretty clear that this is a trend that as long as interest rates remain low, you can absolutely push them higher, but it only goes so far. That's all for this video. If you found that informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. If you want to learn about e-commerce for free, you can do so at the AmazonGPS.com. If you haven't seen my books already, you want to check them out. They are so detailed, so good at explaining such a complex topic for, any wide audience could really learn from it. Definitely check them out at the link in the description. And if you haven't seen my video right here already, I would highly recommend checking it out. You can do so. Just click on this link and I'll see you there.